Hi, I'm Charlie Jamieson, CIO at Jamieson Coote Bonds. This is an update on January markets as we lead into 2019. I think as we open up the year, it's worth taking stock of some of the returns that we saw over 2018, some of the misinformation that was probably put out through media channels, and where we actually landed after the passage of time. It's interesting to us that all of these calls for very high velocity US markets after the Trump tax cuts, or the calls for very high US inflation, these types of calls, RBA rate hikes, they've all proven to be totally wrong. I guess government bonds as well have been in the media for the wrong reasons. Certainly there have been a lot of people that have wanted to discount them as an important portfolio allocation, particularly given that yields are lower than they have been historically. With the passage of time, we can now see that bonds are very negatively correlated, or certainly were in 2018, and they were the best performing asset class in Australian listed investment assets, with a more than 5% return. And importantly, a lot of that return came at a time when equity markets were really under sufferance in the fourth quarter. So it's interesting to look back on that and reflect that with the passage of time, despite all of these calls that have been very negative in and around the complex performs very, very well again, providing great liquidity at very, very high asset quality for investors. As we're opening up 2019, it's interesting to reflect on some of the incoming data that we're seeing around the global economy. Asian export nations, which are the major factories of the world, are suffering a steep decline in data velocity. Now, a lot of that was expected because there was a large inventory build in the back part of 2018 to avoid some of the tariffs that Trump had touted as coming online in 2019. But the rate of change is actually quite extraordinary. Big export nations like South Korea and Taiwan are having draws of between 10 and 14% in their export numbers, which is really very material. Given that economics is a fractional science, these are not fractional moves. These are very large moves, and they're adding to the weight of a global slowdown that we're already seeing with very poor data out of Europe and what has been decaying data in the United States. Over the course of January, we saw the US Federal Reserve complete a stark 180-degree turn, becoming very, very dovish in their outlook, or meaning that they're no longer looking to raise interest rates, and clearly they have material concerns around the pace of the slowdown in their own economy and the global complex. That's come as financial conditions around the world have really tightened quite considerably in the latter part of 2018 via reduced equity valuations, wider corporate credit spreads, and higher funding rates, things that we've been writing about for quite some time. This is a very, very sharp turnaround for the United States Federal Reserve. We don't often see a turnaround of this magnitude. And it does, lead us to have some concern as we look through the outlook for 2019. We know that we have used a lot of future consumption and dragged that forward by using things like the tax cuts. We're going into a period of quantitative decline, quantitative tightening, where central banks are no longer printing money in order to flood economies with excess liquidity. And markets are being asked to stand more on their own 2 feet in an ever-increasing way. And we've certainly seen volatility rise as a result of that. It's worth noting here domestically as well that property prices continue to draw down, particularly in the major cities, whilst credit creation still remains fairly mute, and certainly credit availability has been tightened materially as a result of the Royal Commission. Having said that, in Australia, there are some positive things throughout 2019. We're certainly expecting more government spending, and the employment picture continues to look very, very healthy. So that hopefully counterbalances some of that negative narrative that the housing complex and new construction and building approvals, which we've seen big drawdowns in, hopefully they balance out. But we still expect the RBA to have very little to do and be firmly on hold, as we've predicted for some time.